Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Twilio was founded in 2008 by Jeff Lawson with a simple idea: give developers a clean API to add SMS, voice, and messaging to any application without building telecom infrastructure from scratch.
The developer-first model was radical.
Twilio IPO'd in 2016 at $15 per share. Word spread through developer communities organically, and thousands of companies embedded Twilio APIs into their core communication workflows.
Revenue is roughly 87% communications APIs and 13% data and applications. Gross margin runs approximately 50%, improving as higher margin segment and email products grow as a revenue share.
When a bank sends a fraud alert, a delivery app texts that your package arrived, or an app issues a two-factor authentication code, that communication is almost always running on Twilio infrastructure.
The switching cost is architectural. Once Twilio is built into an application's communication logic, replacing it requires rewriting core software infrastructure, time-consuming, expensive, and carrying real engineering risk.
In 2018, Twilio acquired SendGrid for $2 billion, adding email delivery infrastructure that handles billions of messages per day with deliverability relationships built over many years of operational work.
In 2020, Twilio acquired Segment for $3.2 billion. Segment collects first-party customer behavioral data from every digital touchpoint and routes it to marketing, analytics, and product tools.
Segment is strategically important as third-party tracking.
Active customer accounts exceed 320,000. The net expansion rate has stabilized around 102%, existing customers spending modestly more each year as usage grows with their own business.
Khozema Shipchandler became CEO in 2024 after serving as CFO and COO. His leadership has centered on improving non-GAAP operating margins and returning the business to profitable growth following a period of heavy acquisitive investment.
Non-GAAP operating margin has been expanding toward 14%. Twilio reduced headcount and focused investment on highest return product areas. The pivot from growth at all costs to profitable growth is the defining financial story.
Competitively, Twilio faces bandwidth in CPaaS, Vonage via Ericsson, and Microsoft encroaching from the enterprise side. No competitor has replicated Twilio's developer ecosystem depth at the same global scale.
The API network operates in 180-plus countries. A startup anywhere in the world can build fully functional SMS or voice features using Twilio without negotiating directly with local telecom carriers.
AI is creating new demand for communications infrastructure. Large language models integrating with voice and messaging workflows need the kind of reliable, programmable communications layer that Twilio has been building since 2008.
Key metrics to follow: revenue growth rate, non-GAAP operating margin, and net expansion rate. Those define whether the profitable growth pivot is producing the durable, compounding business model investors are looking for.
That's the company chapter for Twilio. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Twilio just reported 20% revenue growth, a 13% non-GAAP earnings beat, and nearly $1 billion in free cash flow, and the stock is sitting 25% above every single analyst's price target. 300,000 businesses run their customer communications on Twilio's APIs, and management is now deploying AI directly into that existing infrastructure. I'm Hudson.
Twilio is the cloud communications platform that powers the text messages, phone calls, emails, and two-factor authentication flows that hundreds of thousands of businesses send to their customers every day. When your rideshare app texts you that your driver is arriving, when your bank calls to verify a transaction, when a healthcare app sends a medication reminder, there is a strong chance Twilio's API infrastructure is the pipe that delivery runs through. I'm Lana.
Beyond the core communications APIs, Twilio owns Segment, a customer data platform that aggregates behavioral data across touchpoints and allows businesses to personalize communications at scale. And Twilio Flex is a programmable contact center solution for large enterprise customers. The AI opportunity being positioned now is layering intelligence on top of these existing infrastructure relationships, turning Twilio from a communications pipe into an AI-driven customer engagement layer.
Q1 2026 revenue came in at $1.41 billion, up 20% year over year from $1.17 billion in Q1 2025. Non-GAAP EPS was $1.02 against a 90-cent estimate, a 13.3% beat. GAAP EPS was 59 cents, with the GAAP to non-GAAP driven by stock-based compensation expense.
The margin story has two readings. Non-GAAP operating margin is approximately 18%, a real business generating real operating leverage. GAAP operating margin is 7.7%, reflecting the SBC load that has been the persistent criticism of cloud-era companies. Gross margin is 48.8%, lower than pure software peers, but appropriate for a platform with meaningful infrastructure costs.
Cash generation is the standout in this report. Operating cash flow TTM is $1.0 billion. Free cash flow TTM is $935 million. That is a genuinely cash-generative business, and the balance sheet reflects it. $2.35 billion in cash against only $75 million in debt. Net cash is $2.27 billion. Equity stands at $7.78 billion.
Valuation is where the conversation gets complicated. Trailing GAAP PE is 217 times, essentially meaningless as a valuation anchor. The relevant number is forward non-GAAP PE at approximately 28 times, which is a reasonable multiple for a company growing revenue at 20% with expanding non-GAAP margins. Price to sales is 4.23 times at a $22.4 billion market cap.
The buyback announcement is the capital allocation signal the market has been watching for. Management authorized a $2 billion plus repurchase program. With $935 million in annual free cash flow and virtually no debt, Twilio can buy back stock while continuing to invest in AI product development. That combination, growth spending plus capital return, is the maturation signal that enterprise software investors typically reward with multiple expansion.
Beta is 1.28, lower than FSLR or DXCM, which is notable for a tech name. No dividend. The return story is entirely buyback and price appreciation. 300,000 business customers create a usage-based revenue model. As those businesses grow, Twilio grows with them without new sales motion required.
16 buy ratings, 3 holds, 1 sell, and a consensus target of approximately 118 against a stock price of 148. Twilio is trading 25% above where the street thinks it belongs. That is the mirror image of Dexcom's setup. Same magnitude of divergence, opposite direction.
The analysts who set 118 targets did so before this quarter's 20% revenue beat and before the buyback announcement. The question for the next few weeks is whether those 16 buy-rated analysts upgrade their targets to reflect the stronger than expected execution, or whether they maintain targets and implicitly downgrade their conviction by letting the stock trade through their price objective.
The 1 sell rating reflects a view that the valuation at 148 is simply not supportable by the GAAP earnings reality. 217 times trailing GAAP earnings is hard to defend on a fundamental basis, and the seller's argument is that non-GAAP normalization obscures a business that is consuming significant equity capital through SBC.
The 3 hold ratings are more nuanced. They like the business but see the risk-reward as neutral after the run to 148. At 118, they were presumably buyers. At 30% above that level, they are comfortable sitting.
The street consensus creates a peculiar dynamic. A stock that 16 analysts call a buy is trading above all of their targets. That either means the analysts are behind and target upgrades are coming, or the market has run ahead of the fundamental reality. The next 2 quarters of execution will resolve that question.
The bull case is the AI engagement layer. Twilio already sits inside the communication stack of 300,000 businesses. Adding AI capabilities, conversational AI, predictive customer engagement, real-time personalization, on top of existing API relationships is a land and expand motion that does not require winning new customers. The incremental revenue comes from existing accounts deepening usage.
The balance sheet amplifies the bull case. $2.27 billion in net cash, $935 million in free cash flow, virtually no debt, and a $2 billion buyback authorization. Management has the resources to invest in AI product development while simultaneously reducing share count, a combination that compounds EPS without requiring top-line acceleration.
20% revenue growth at $1.41 billion is not a small company growth rate. If Twilio sustains 20% growth with non-GAAP margin expansion from 18 to 25%, the earnings trajectory justifies the current price, and the analysts who stayed at 118 will have to revise.
The bear case starts with SBC. GAAP EPS of 59 cents versus non-GAAP EPS of 102 means the company is paying 43 cents per share in non-cash compensation every quarter. That is real economic cost. It dilutes existing shareholders. And the 217 times trailing GAAP PE is the market's honest accounting of what the business actually earned.
The competitive threat is real and well-resourced. Amazon Pinpoint offers communications APIs with AWS pricing and AWS distribution. Salesforce competes in the enterprise contact center and customer data platform space directly against Twilio Flex and Segment. Both competitors have deeper enterprise relationships than Twilio in their respective domains.
And the stock being 25% above consensus target means there is no analyst support for the stock at current levels. If the next quarter shows any deceleration in revenue growth, from 20% to 15%, the multiple collapses faster than the earnings change suggests, because the premium valuation is built on sustained growth expectations.
The gross margin at 48.8% also has a ceiling. Communications APIs carry meaningful infrastructure costs, SMS termination fees, carrier interconnect, compute for voice processing. As Twilio scales, those costs scale too, and expanding gross margins towards software-like levels requires a significant mix shift toward higher-margin AI and data products.
Zoom is the peer most often cited alongside Twilio. Both are cloud communications platforms that benefited from the pandemic digitization wave, and both face questions about their growth trajectory as that tailwind normalizes. Zoom's revenue mix is more consumer-facing. Twilio is almost entirely enterprise API.
Five9 and NICE operate in the contact center software space, where Twilio Flex competes. Both are specialized cloud contact center vendors, pure plays against which Flex is more of a programmable alternative for companies that want to build custom contact center workflows rather than buy a packaged solution.
Bandwidth is the most direct infrastructure peer, a programmable communications platform competing for the same API-first developer market. Bandwidth tends to compete on price and carrier relationships. Twilio competes on developer experience, product breadth, and the segment data integration advantage.
The relevant competitive summary is that Twilio has the largest developer mindshare in the CPaaS category by a significant margin. 300,000 business customers represents a network effect that new entrants cannot replicate quickly. And the Segment acquisition gives Twilio a data layer that none of its direct communications peers have.
Options positioning in TWLO at 148 is particularly interesting, given the stock is above every analyst target. Implied volatility reflects both the earnings catalyst that just passed and the ongoing question of whether analysts upgrade their targets. A stock this far above consensus targets tends to attract both momentum buyers and mean reversion short sellers simultaneously.
The buyback authorization creates a technical support mechanism. With $2+ billion authorized and $935 million in annual free cash flow, management has real firepower to buy stock on dips. That backstop is one reason the stock has held at elevated levels. There's a credible buyer at lower prices.
Insider activity at Twilio has followed the standard large-cap tech pattern, 10b5-1 program selling by executives managing concentrated positions. No unusual cluster selling has been flagged, and the buyback program sends a countervailing signal from the corporate level. Net insider activity is not a primary concern at current levels.
The growth fund and tech-focused institutional base is substantial. Beta of 1.28 means TWLO tracks the NASDAQ closely, but with less amplification than higher beta tech names. The next catalyst is the Q2 2026 earnings report, and any confirmation that the AI product layer is driving incremental revenue will be the signal analysts need to revise targets higher. 20% growth, a 13% earnings beat, a buyback authorization. The fundamentals are executing. The problem is the stock is 25% above the street's targets. That is momentum buying, not analyst support.
If the AI layer generates incremental revenue, analysts revise and the premium is justified. If growth decelerates even slightly, the correction is fast. This is a conviction trade. You need a differentiated view to own it at 148. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall